Thank you everybody who was brave enough to stay this late. In this presentation I'm going to focus on risk, but since I knew that in this room there are going to be a lot of bright affiliate marketing minds, you might work in-house for the credit company, and you might be interested on how other people are doing risk management, but mostly if you don't work in a credit company or in a lending company, you don't know exactly how it works, all the part of the different risk management. So hopefully everybody can find some interesting information. It doesn't matter if you work more or less in the risk side. But I would like this to be useful to everybody. First, let me introduce myself. My name is Lopez Pino. Oops, the clicker is this one, right? Yeah. I founded my own company, Shuttle 99, more than 2 years ago after working in the banking and lending industry. I usually say we help fintechs in general, lending companies in particular, with their two biggest problems. The first one is to be able to score customers, and the second one is to be able to attract customers. We work, for instance, for PSD2 companies or companies that work with bank account data. Probably you know Instantor because it's here in Poland. It's a strong competitor of Contomatic that is in more than 25 markets. Also, Account Score is a similar service in some ways, also process some bank account information and do categorization, income verification, risk models. And I also work for some lending companies, some of them not mentioned there. We attract customers to all kinds of financial offers. We're focused on installment loans and credit cards, but we also do payday. We do it in Spain, we do it in Mexico, we do it in Colombia, we do it in Ukraine. Recently we started in Poland, we're just testing the waters. Recently we started in Argentina, we're also testing the waters. And that's why I think I can share with you some insights on how you can improve how you acquire customers if you understand better the risk part. Because the good old times when the lenders will pay you for every single loan are gone. They started not to pay for repeated loans, then they started to pay you for qualified leads, and finally now it's very, very common, depends on the market, that they only pay you for disbursed loans or only for customers that pass their credit scoring. So as affiliate marketers, I think it's extremely relevant that you understand how some part of the risk management work, so you can bring better quality to the campaigns and in the end have a more profitable business. And if you ask me, does it work? Our experience is that it works. We had the CEO and global CMO of Spring Finance here. He just mentioned that the connection between marketing and risk is one of the holy grails of lending. I totally agree. That's a very big part of our business, and we very frequently are approached by affiliate networks or by other publishers that are surprised by our results. Our results, for instance, is that we can bring volume to prime campaigns that they are not able to do, but because they are only able to acquire subprime campaigns, subprime customers, sorry. And we also sometimes have very, very, very low cancellation rates. In other cases, we offer campaigns no other publisher has access to just because they know about our track record working on similar campaigns, and that's why we are focused on installment loans and credit cards in Spain without having a call center or any other, let's say, more traditional way of selling those products. But let me start from the beginning to talk a bit about risk management. We have to know how old school risk management still looks like, and in particular how the field looked like about 10 years ago. That it was when peer-to-peer lenders started to become popular, and also the investment in big lending groups started to become popular. As you know, the kings of the traditional credit risk management are credit bureaus. They say that they have more than 2 centuries, that already 2 centuries ago they started to keep a list of good customers, of bad customers, but probably you don't know that much that there are very different credit bureaus depending on the market you enter. There are credit bureaus that have positive data. That means if you have a bank account or if you have a loan that you took, and in particular if you took a loan and then you repaid, you create some good history. But unfortunately, that's not the case in all the countries, and in some countries you can only have access to negative data. So for instance, in Spain, if you are not a regulated lender, you can only know the bad history record of the customer. But in practice, there's other information that the credit bureau data has about the customer. This changes a lot from market to market. But for example, in the Netherlands and in Spain, the credit bureau experience said, well, we don't have much information about the customers, we're not the market leaders, what can we do? They started to collect demographic data. So if a lender is using Experian in Spain or in Netherlands, it's very likely that their scoring is very much based in demographic data, and in particular about where the customer lives. And said by people at Experian, sometimes when they refresh the data about all these demographics, that sometimes happens when the elections happen in a country, they actually perform better than when the data is a bit outdated about the different customers. Besides that, we have many examples of different information that credit bureaus are trying to collect. They're trying to collect your history about your telecommunication behavior, the official gazette that many countries publish, so if you do something very wrong, probably it will go there. But yeah, this is not the core of the information they have been working with, and this is only, let's say, a small part of the business in some cases. Another thing that they do is that they do credit scoring. Sometimes even lenders don't know. Credit bureaus have more information than what they offer to the lender to do the credit scoring, and I know this myself because I've seen it in some markets. To give you an example, if you are in Germany, the main credit bureau is called Schufa, and Schufa knows the name of each bank that allowed you to open a bank account. For some type of customers, this can tell a lot. In particular, for those customers that don't have a very big credit history, if you have a bank account with a good bank or with a bad bank, that can tell a lot. And they use all this information in the scoring. So for instance, if you try to reverse engineer their score and you use the data that they're offering to you, you will see that for some customers you will find big differences. So in general, they offer this service to lending companies. Traditional lending companies use it a lot. Usually the credit scoring is expressed in the probability that the user stops paying after 12 months, because it's, let's say, the common way banks used to look at risk. And most of the time, this score doesn't take into account the application information that the user introduced, although each credit bureau do it differently, or some credit bureaus have a different scoring system. So in Netherlands, if you are applying for a car loan, or if you're applying for other type of loan, the credit bureau will give you a different score. And then there's the traditional lenders application scoring. So surprisingly, many lenders and some credit bureaus take into account how much money and for how long the customer wants to use it. From my experience, you can find some small patterns there. So for instance, I've seen in a lender that when a customer requests the minimum amount of money or the maximum amount of money, those two types of customers were a bit worse than the customers that choose any other amount. Our theory behind it is that desperate customers either will try to apply for as much as possible, or they will know what is their credit history, so they will apply for the minimum because they think that even 1,000 euros, nobody will be crazy enough to offer them that amount. But I'm very surprised, still many scorecards and systems to decide if a customer is going to get a loan or not are based on that. Then you have all the application data, the demographics data, some data I really don't understand. If you work, I don't know, in lead brokering, probably you have seen those applications where they want to know if the customer has a DSL high-speed connection or a slow connection. I really don't believe that can work very well predicting the creditworthiness of someone. If the customer has a phone contract or not, how many child they have. In my belief, it's just demographic data. You can find some small patterns there, but it's going to tell you very little about if the customer can repay and if the customer is willing to repay. And of course, as I said, they try to include the credit bureau data directly or indirectly. So this is more or less what I call all the school risk management. That is what existed, let's say, 10 years ago, still in the online space, and of course exists in many banks. So what is modern risk management? Well, some people think about the robot playing the piano, artificial intelligence. Actually, if you go, oops, skip. Oh, there's one missing a slide, sorry. Sorry, this one was supposed to go next. And if you go to the meeting between a lending company and an investor, you will find that they all are experts in credit scoring with artificial intelligence. Actually, I don't know any lending company that uses artificial intelligence for credit scoring. I don't think any lending company knows what artificial intelligence is. They're not robots playing the piano. And actually, many of these tasks, they outsource it to companies like us because they just don't know how to do credit scoring, and sometimes they have very simple methods and they're still in the old school world. So approximately, let's say, 7 years ago, this started to be the norm. What we could call modern risk management. People, of course, were still taking into account the positive and negative records of the credit bureaus, but also started to be only a small part of the information they use. It started, I think, a stronger analysis of the competitor. I was very, very surprised visiting some lending companies how much they know about their competitors. In particular, if they're peer-to-peer lending companies, they try to learn as much as possible about the data they disclose or about the data they disclose in their statements that you can find on Mintos if you're an investor. Something very interesting that happened with the online world was the importance of the customer lifetime value. In the old time, they were just looking at the profitability of the first loan, at the first payment default, and things like that. But then they started to focus on repeated customers. The CEO of Cream Finance also mentioned a lot about this. They started to look at whether the customer is going to repay, something that he didn't mention. They started to look at whether the customer is going to extend the loan or not. Because, believe it or not, you might think the best customer of a lending company is the one that repays the money the best, but not always. Sometimes online lending companies want those people who fail a few payments, so they get charged a bit more in fees and things like that, but end up paying the loan a few months late. Those are good customers, and sometimes actually they call the customer and they offer, oh, don't repay the whole loan, just take the money for a bit more, we are a very cheap company. So that's why these 0% interest rate loans exist now in Russia, Poland, Spain, and many other markets. They're super focused on customer lifetime value, and this should be part of your credit scoring engine when you are a good lender that has been operating in the market for a little while. Then I will talk more about it later, but the bank transactions, the famous PSD2 data that we don't even ever know if PSD2 APIs will exist, but has been available for about 7 years or maybe more through screen scraping. Tell us a lot, I will go a bit more into that. And also the borrower behavior. This maybe was a bit too hype, but it is true that with the borrower behavior, and by borrower behavior I mean what he does in the website, how many times he contacted the contact center, you can get rid of some bad customers. It's not great, but it's also part of the recipe. And in the end, the other big part about model risk management is to use more data science, to use more machine learning, and I will go a bit more into the details later. And I was talking about customer lifetime value. As someone who acquires customers for lending companies and has worked for lending companies, I'm very surprised that still loyal customers and repeating customers are the most important asset that a company has. Usually when you see that a lender is bought by someone, what they really want to start with is their current portfolio to see how much money they can get out of the already existing customer, but still as a lead broker or as a comparison website, they don't want me to send them repeating customers. I think lenders have a sense of ownership over those customers, and they think, oh no, it's already my customer, I don't want to pay for it. I think they're making a mistake. Some lenders do pay for repeating customers, some lenders pay a smaller fee for repeating customers, but I have that person hungry for money on my website, and you already know that he's a good client. That should be, in my opinion, they should pay even more for those leads. And some of them are not even willing to pay, but I think, as I said, the industry is focusing more on customer lifetime value. They will start competing also for this traffic, in particular in markets where the overlap of the portfolio is sometimes 90%. So if I'm not going to send it to one lender, I'm going to send it to another lender. It was the last slide. Yeah. Another thing, maybe not very important for customer acquisition, but probably you all got all these sales cancelled because of fraud or leads cancelled about fraud. Sometimes it might be true that some fraud was detected. Sometimes it might not be true, but the reality is that lenders are at least testing many different ways of verifying the identity, of verifying the address of the customer, even of doing device reputation, even doing IP reputation. As I said, I don't think it's a huge thing. There are also e-commerce report fraud. So if someone tried to do fraud in an e-commerce website, they want to know that this person did that. I think lenders are constantly trying these kind of things, but I don't think they're seeing huge improvements, including in this. And there are some other things that when that gets their attention, they get better return on their time invested. What is really the king of data nowadays, depending on the market, is bank transactions. Probably you know it here. Many payday lenders, they use Contomatic, some installment lenders as well. In Spain, it's a very similar situation with this Tantor. It depends on the information available in the credit bureau. For instance, in Spain, as I said, there's not enough information in the credit bureau, so a lot of people are resorting to these kind of solutions. But also, if we compare it with demographics data, it gives you really real insights on the current financial situation of the customer. And I think it's more fair to the customers that you use this data to score them instead of using the postcode or the address or whether how many kids they had. With the bank account transactions, you can see if a person is consuming a lot of payday loans or only payday loans when they need it. You can see if they're all the time in balance zero or if they actually are just sometimes in balance zero and just need a little bit of money. You can classify the expenses. You can figure out if they could actually reduce a lot of expenses that are not important and start repaying their loans in general, and not to talk about some bad habits. With that, I mean, there are countries where if you withdraw a lot of money in an ATM, this is very, very, very suspicious. Let's think of Sweden, where everybody pays everything by card. Or let's think of Spain, where we unfortunately have a huge crisis with gambling. There are a lot of people getting addicted to gambling and betting. So in general, I think it's a way more fair way of scoring the customers. And what we do, and what some others are also trying to do, is automatically recognize patterns in the bank account. What do I mean by this? Sometimes you can put a bit of the robot to play the piano, to say it somehow, and you can find patterns that seems to predict if the customers repay or not. Let's think, for instance, if the supermarket choice that they make is good or bad. Is if they go to an expensive supermarket, or if they go to a bad supermarket. It's a very stupid example, probably not going to work, but this is information you have in the bank account. So you can try all these kind of patterns, you can try all kind of keywords, you can try all the keywords automatically and see which ones help to predict the behavior. What we usually do is that we do that, and then we look at the keywords that work, and then we try to articulate a theory around it. So let's say, okay, maybe if some of the supermarket keywords work, we should do a categorization of a supermarket and see if that categorization works. And in the end, you're just trying random label to see if they can predict or not the repayment. And I have seen some lenders very, very impressed with the results of such automatic patterns. Another thing, you probably know it, but you don't know how it is from inside a company, that some lenders, in particular, when they are in a bad situation, they start opening and closing the acceptance rate. Suddenly, one day they are only accepting 2% of the customers, and the day after, they are accepting 20% of the customers. This is not real data, but this is a simulation of very similar data you could find about the acceptance rate of 3 different lenders. What is happening? Sometimes it's just investors. Investors are telling you, please spend 2 million euros this month because I want it, and you have to do it because they are the owners of the money. So even if you don't agree with the decision, you have to do it. So sometimes you want to meet some business goals. So you want to show your investors that you are issuing a lot in a new market, even if you know that in 3 months you are going to burn all that money. That happens. And sometimes actually there's, I would say, better intentions behind it, that is learning. Sometimes you say, okay, I'm going to learn to 25% of the customers, and then out of that 25% of the customers, I'm going to try to learn which ones are good or bad. So kind of testing the waters and see what comes. Obviously, thinking of the customers, maybe this is not a good practice, this is not responsible learning, but the reality is that it happens. So to try to arrive a bit to the conclusions, of course, here I just wanted to give you a high-level understanding of how the risk management works, but what can you actually do if you are acquiring traffic and you are not part of the lender, or even if you are part of the lender, to try to improve how you work. So I will start with very, very small things. The first sentence sounds really bad, but talk to people who actually know about what's happening with the credit scoring. Because about 80% of our lending organization don't really know what's happening in the credit scoring, don't know what kind of variables are being used, don't know if the acceptance rate is going to increase or decrease. Maybe they just find out when they see the results of those changes. But there's 20% of the organization of a lending company that know what's the strategy, know if that acceptance rate is something they're going to maintain in the long term, and actually how that credit scoring is done. I learned a lot by doing that. Then, something might sound stupid, but read the small print. There's a lot of information, I don't know, in the terms of conditions of a company about what credit bureau they're using, if they are using instant or automatic or none of them, because usually this is information they have to disclose to the end customers. So reading the terms of conditions or the small messages that, or sometimes they could mention what is the age range that they accept of the customers in the small print. So this is something I try to do every time a lender becomes relevant in one of our markets, to see if I can find some indications about what type of product and what type of clients they want. They usually have this section where they say, what do I need to get a loan? I found out that many people don't fully understand what it means that you don't need a salary proof. What does it mean that you don't need a salary proof? Does it mean that anyone can get the loan? Does it mean that someone who is on unemployment can get the loan? Does it mean that you can use a tool like Contomatic or Instantor to get the loan? What does it mean exactly? Behind those big words, sometimes there are some details you can understand. Another thing that we do a lot is to classify the products. Not only how much money you can get, that is what almost everybody thinks, not only if they accept customers who are in the credit bureau or not, but try to understand what kind of customers they try to acquire. For instance, sometimes they do a classification of installment loans that are near prime, or if they are more like subprime loans, because they might offer the same amount, but they could be focused on a totally different customer group. And then the next step for me is to look at how you present the product to the customers. This is something we are very amazed with. We are testing a lot how we present the product to the customers. We try to get the best information about what is relevant about each product. Maybe one product, the customer just lacks the trust on it, and that's why they don't get it. Maybe sometimes they don't know if they will get it because they are not salaried. So figure out what you have to, how you have to present the product to the customers. So you only send the relevant traffic. Or if you are sending traffic to, we do for instance in Colombia sometimes, business loans. So we try to disclose as much as possible of the requirements of the kind of customers they want in our website. Sometimes those details are not in the website of the lender, but we talk with the lender and we say, what kind of companies you will give a loan to? And they will say, well, we only lend to companies that at least have 1 million in revenue. Okay, then we will disclose that information in our website, so we only send the relevant customers. Then look twice at how you measure the performance. Sometimes it's very tempting to only look at the EPC and to how much money you're getting out of it. But for instance, some companies, if they pay you for CPL, sometimes they can also give you a post-back call when they do the acquisition, when they disburse the loan. This is actually useful information because maybe you're sending them a lot of leads that they are accepting, but your conversions from leads to disbursed loan is very low. And if you understand this, you know which ones are disbursed, you can find more of that traffic, then you can go to the lender and you can say, I know I have a very good conversion rate, could you raise the payout? And sometimes you can also ask them to disclose what are the rates that other companies are getting and base your negotiation in that. Another thing is to look at different sources of traffic. I think that was also mentioned by the CEO of Green Finance, and you also have to do it as a lead broker. Sometimes you're sending very low quality traffic to the lenders, but you see that it's profitable for you, so you don't care. Okay, if you're here for the short-term profit, maybe that's a good strategy, but if you're for the long-term profit, probably you should care much about the sources of the traffic as the lenders do. Well, there's another thing, sometimes I think people don't realize that the data is biased. Obviously, it's not the same acquiring, if you're acquiring customers with an